Venture Global's latest earnings call, man, it was a real tale of two companies. On one hand, you have this absolute growth machine that's just shattering revenue records. But on the other, you've got a company tangled up in some pretty serious legal battles that are really spooking investors. So the big question is, which one is the real Venture Global? Let's dive in and break it down.
First up, let's talk about the top line. And wow, it was absolutely spectacular. Venture Global pulled in $3.33 billion in revenue, and that just sailed past what the analysts were expecting. We're talking about a staggering 260% jump from last year, all thanks to a huge surge in their LNG exports.
But just as investors were celebrating that massive revenue number, the other shoe dropped. Adjusted earnings per share, they actually missed expectations. And this, right here, is the central puzzle of the quarter. How can a company growing this fast be falling short on the bottom line?
So to really get what's going on here, we need to follow the money. We're going to start with a snapshot of the earnings, then we'll get into management's side of the story. After that, we'll dissect that guidance cut that has everyone so worried. And finally, we'll give you our take on what this all means for the stock. Okay, let's get right into the earnings snapshot. And this really was a quarter of contrasts, where the headline numbers were telling two very, very different stories. Just look at these numbers. I mean, they aren't just good, they're absolutely staggering. You're seeing a 439% jump in adjusted EBITDA and an almost 600% explosion in operating income. And check out the net income. It swung from a huge loss last year to a massive profit. This company isn't just growing, it's becoming a legit cash printing machine. So you can imagine, faced with that EPS miss, management came out swinging with a really strong narrative. Their whole focus was on execution, on operational excellence, and on the enormous growth pipeline that they are building right now.
And you can really hear it in the CEO Mike Sables' own words. He framed the quarter as nothing short of extraordinary, and you'll notice he put all the emphasis on the physical achievements, the stuff they're building, rather than the short-term numbers that had Wall Street worried.
And listen, they brought the receipts to back it up. A record 100 LNG cargoes shipped in a single quarter. Brand new 20-year deals that lock in revenue for decades to come. Their next mega project is on track, and they've raised a mountain of cash, $30 billion, to fund it all. This is literally what hypergrowth looks like.
But just when it seemed like everything was firing on all cylinders, management dropped a bombshell. They cut their guidance for the full year. And this, my friends, is where the story takes a very sharp turn. So this is the million-dollar question, isn't it? If you're exporting record volumes, signing deals left and right, why on earth would you lower your forecast for the year? It's this exact disconnect that has investors scratching their heads. And here's the cut. Plain as day. The company narrowed and lowered its full-year guidance for adjusted EBITDA. Now, it might not look like a huge trim, but believe me, for a high-growth company like this, any reduction in guidance is a major red flag for the market. So why the sudden caution? Well, management gave three reasons. First, they're setting aside cash, taking what are called accounting reserves to cover potential losses from those legal battles we mentioned. Think of it like a rainy day fund for lawsuits. Second, the prices they're getting for some gas are a little weaker than they thought. And third, a couple of shipments are just getting pushed into next year. But it's that first reason, the legal overhang, that's really weighing on the stock. Which brings us right to the core of the whole issue. There's this massive disconnect between how the company sees itself and how the market is valuing it. You've got a tale of two completely competing narratives.
It's almost like management and the market are watching two different movies. Management thinks they're in a blockbuster action flick about building giant projects and conquering the globe. The market, on the other hand, thinks it's watching a tense, legal thriller full of risk and uncertainty. And right now, the thriller is winning.
And, well, this chart says it all, doesn't it? This is the result of that disconnect. So far this quarter, while the S&P 500 was up over 6%, Venture Global's stock got hammered, down a painful 34%. This is the market pricing in all of that risk and showing just how skeptical it is of the growth story, even with those incredible operational numbers.
So after digging through all of that, what's the bottom line? Is Venture Global a buy, a sell, or a hold? It is time for the next call.
This is what it all comes down to. What are the really critical signals to watch for in the next quarterly report and into next year? What's going to decide whether management's story or the market story ends up being the right one? Okay, here's our three-step analysis. First, for Q4 results, we expect the cargo volumes to keep on growing, but the main event is going to be any news at all on those arbitration cases. Second, for the stock price, expect it to keep bouncing around. But as those billions in cash flow keep rolling in, a fundamental floor should start to form under the stock price. And third, that brings us to our rating.
Our rating on Venture Global is outperform. Look, the market is completely obsessed with the legal risks right now, and we think it's missing the forest for the trees. This is a company that is fundamentally changing the LNG game, and we believe that sooner or later, the stock price will have to catch up to the reality on the ground. The big question is just, how long will that take?
This is not financial advice.